Well, good afternoon, ladies and gentlemen, and welcome back. Today's session, we're going to cover the concepts of debt and equity financing. We will also see at the back end of this presentation cost of capital slides, but I will break that up into a different section just to be able to cover it in a little bit shorter period of time in one sitting. So to get things started off, first and foremost, we have to understand what capital is. Capital really, as the screen shows here, represents the funds used to finance a firm's assets and operations. Okay, and you'll find how we capitalize a business on the right-hand side of the organization's balance sheet, whether that's a not-for-profit enterprise or a for-profit enterprise. Both are shown on the right-hand side, which includes debt liabilities as well as any sort of equity stake or equity position. So from a very basic and fundamental standpoint, it should be obvious by this point that businesses need capital to acquire assets and to be able to provide the services required to sustain ongoing operations. And from a very, again, fundamental perspective, capital comes in two basic forms, both debt and equity. Okay, and based on what we've learned in the prior sections of this course with respect to interest rates, hopefully we can now understand that capital is allocated in a free market by price or by the rate at which you have to repay. Okay, so those businesses most able to pay are those that are able to generate the best cash flows and are able to attract the most interest from basically the public, for lack of a better term, often are the ones that can get the capital. Where we see organizations struggle or having to use alternative sources of financing generally are those organizations that have or are struggling from a cash flow standpoint, haven't proven their business model, or simply aren't where they need to be with regards to cost structure and revenue generation in order to attract the interest in capital investment. And if you really think about it, as you look at, watch the show, the Shark Tank, and you think about, what organizations do when they go back to the equity markets, let's say, really we see those individuals that come into the Shark Tank, for example, are the ones that struggle, or the ones that are struggling are the ones that haven't really proven their business model, haven't really shown that their cash flows are protected either by virtue of a patent or some sort of unique idea, and those that have not really started to generate sufficient cash flow or simply that don't know their numbers. Those are the folks that really get eaten alive in that setting. So again, capital is allocated in our market by price, and those that are able to prove it and prove their business model are the ones that gain access to capital the easiest. So a couple different of our two primary sources of capital, we have debt and equity. We will often hear debt termed as leverage, okay, basically using other people's money or borrowing other people's money to be able to lever up growth. And of course there's both good and bad uses of debt. If we're using debt in order to finance growth that's going to produce more revenue downstream, that's good use of debt, that's good leverage. For organizations that are borrowing in order to keep the lights on and to pay salaries and to sustain very short-term interests, not a real good use of debt, and it's basically an organization that will soon be out of business if they don't find other sources of growth or other sources of revenue generation. On the other side, we have equity. Basically everything that's left over after we've basically paid off all of our debt obligations. So we can often term equity not only in terms of the equity stake that either the founders or partners that have provided capital, the stake that they have in the organization by agreement, as well as we can term equity as basically the proceeds of ongoing operations that get basically retained by the organization, again on the right hand side of the balance sheet. So again, as we move forward, that debt can take the on the debt side of the sheet, we can really look at it from several different forms depending on the size of the organization. Some of these are going to be more likely than others to be seen or to be used. Of course, for small businesses, it's a bank loan. It might be a loan from a family member even, whatever the case may be. Of course, for larger publicly traded firms and even not-for-profit organizations, we will often see bonds leveraged as a point or a way to basically generate capital and again finance sustained operations and growth. Equity, of course, can also take multiple different forms. Small businesses, it might be your own savings account, it might be again equity positions from a family member that can provide you some money in exchange for a percent of the business. Venture capital, this is where angel investors get involved, venture capital firms, what have you, depending on the quality of your idea and how well you've developed it and what have you done so far. And then, of course, the larger organizations, the whole IPO or initial public offering, common stock generation, and then, of course, there's multiple variants to both sides of this. We can have very different forms of both debt and equity, but these are the two major or primary forms. And as we look and consider the two sides, there are nuances and differences that we have to understand. As we look at the left-hand side here with debt, debt is a fixed claim, meaning that we have, when we take out some sort of loan, if you think about a car payment, a mortgage payment, whatever, there's a fixed claim on your assets or on your cash flow streams, if you will, and that is basically the payment amount that you have to meet in order to pay off that loan. And as we look back into prior sections, the whole amortization process, where we actually figure out that payment and figure out the term of the note, figure out how much goes to principal, that is all part of that fixed claim. Because of that, there is a high priority on cash flows. So organizations that have very cyclical or very unstable cash flow streams typically will have a harder time going to the debt markets in order to finance growth and moving forward. So a high priority of cash flows basically means that those lending institutions, that banker is really going to be interested in getting paid back. And if you have very cyclical, very seasonal cash flows, if they're not really secure in his or her mind, he's much less likely to to give you that loan. Advantage of debt, it is tax deductible. It is an operational expense, so we are able to adjust our taxes appropriately. And last, on this particular chart, there is a fixed maturity. Once we pay that note off, that creditor, that lender has no further claim on your business, and we consider that note to be satisfied. On the right-hand side here, equity, there is a residual claim. So if you think about any organization that goes bankrupt, goes out of business, all of the creditors are paid first. Any equity holders are paid on a residual basis, whatever is left over. Okay, which if you think back in the days of the Enron, those poor souls that had invested everything in Enron for their 401ks and retirement funds really received pennies on the dollar based on what they had in terms of an equity position after all the creditors were repaid from what was a global enterprise. We have less of a priority or lowest priority of cash flows. Equity really is, once that equity dollar amount is basically traded in exchange for a percent interest in the organization, that equity holder doesn't necessarily have to be paid. Obviously they would enjoy that, they would like that, but when push comes to shove, we're going to pay our debt side first before any equity stake gets satisfied. There is no tax break on dividends, unfortunately, and this is a whole line of discussion and thought that we'll set aside for another time with regards to double taxation on corporate structures and whatnot with respect to dividends, but in some case triple taxation. But we don't receive the same sort of benefit from dividend payouts as we would on basically servicing a debt commitment. And last but not least, unlike debt that has a fixed and very terminal structure to it, once you give up an equity stake, unless it is somehow sold, there is an infinite life. So that's something that can be passed down from generation to generation, and certainly something that is worth considering if you are sitting on top of a likely very lucrative organization or idea And this is some part of the discussion again that we see in the Shark Tank environment, where individuals really have to think hard about how much equity stake they give up, because that individual has a perpetual stake in that company, either or directly or through passing it down. So again, as we look at the two different sides, again, debt and equity, from a cost standpoint, one could argue that truly debt has the lowest cost in terms of, again, kind of tying back to that perpetual life that equity brings. Risk to the firm is relatively high with debt. Obviously, if you go bankrupt and there's a volatility of cash flows, as I explained before, that can be incredibly risky to the firm because of the threat of bankruptcy, and relatively low risk to the firm on the right-hand side with regards to equity. Impact on flexibility, there can be, depending, and this is arguable depending on the percent equity stake involved, but impact on flexibility and on control. You can kind of tie these two together, the last two lines here. Depending on the size of the debt issue, depending on the circumstances involved, there can be restrictive covenants involved, especially with bondholders, that are worth considering. Whereas the equity, basically if I give up 10% of my shares to a particular individual or organization, if they're not a majority holder, there's not much that can be said. But from a control standpoint, unless we're going into bankruptcy proceedings, that's not really a concern or unless there is a very large bond issue that we have a board of trustees that act on behalf of the bond holders. We tend not to see a lot of control aspects. Okay, again, nuances, and there's certainly exceptions to any of this. But on the right-hand side, again, the higher percent stake that somebody beyond the founder has with regards to equity certainly can play into control and organizational basically proceedings going forward. So I'm going to unpack further each side of both debt and equity. Truthfully, we're going to spend more time on the debt side, simply because that's going to be part of what you're really going to be required to know for the homework for the course. I'm going to explain a little bit on the equity side why we don't do some of the things that we might see in the textbook and my logic and reasoning for that. But we'll start with debt, turn to equity, and then close this particular session out, and then pick it back up with our cost of capital discussion. So first and foremost, what is debt? Basically, if you can claim all three of these, you can say that it is a debt instrument. If not, then we can say that it's some other type of investment or some other type of obligation. First is the cash flow claim created by this financing a fixed commitment. Okay, if it's a fixed commitment, we're basically, as I've explained on the charts before, that's a debt. Is the commitment tax deductible? Of course, as I explained before, it's a debt. If you fail to uphold the commitment, do you lose control of the business? Again, that's the bankruptcy issue, and then it's a debt. And again, if we have nuances to this or otherwise would claim no to any of these, then we're looking at some other form of claim. So some basically options with regards to short-term debt. Of course, there's different needs for financing within an organization. Of course, we're not going to fund anything and everything through a bond issue, which of course is very laborious and very expensive. So we need to have various different options for borrowing for really any organization. And of course, as the organization grows in size, that's going to create more opportunities to kind of expand the potential debt portfolio. But we use short-term debt, primarily for the purposes that it's faster, there's lower issuance costs, fewer or no restrictive covenants, as I've explained before with large bond holding issuances, and there's generally a lower interest rate because it's a shorter term, and this goes all the way back to our risk discussion, interest rate discussion, that we had previously in the course. Shorter terms mean lower interest rates. That's the term structure of interest rate kind of personified. Disadvantages over long-term debt, there's two issues primarily. Rollover risk, the threat that interest rates will rise, which may limit continued access to capital, and the renewal risk, our ability to pay off that debt okay, as we need new rounds of debt to satisfy short-term obligations. So some common types of short-term debt. One, commercial paper, which is more frankly leveraged by larger organizations. If you don't know what commercial paper is, it's essentially an IOU that's exchanged between large companies to meet short-term liquidity requirements. So that might be between Johnson & Johnson and GE, for example, at a very short-term rate, and for a nominal interest percentage. Bank loans, of course, that's what most of us are most familiar with for any short-term debt obligation. We'll consider that generally to be a note payable. And of course, we also have things like lines of credit and that sort of thing that basically, again, help to sustain short-term operations. Primary sources for long-term debt are term loans and bonds. Term loans, really, you could argue, could be on either side of this fence between short-term and long-term. But depending on the nature and length of the term, we lump it over here, considering that it might be a little bit longer than what might otherwise be considered short-term from an accounting standpoint, which is basically a year or less. So two primary sources, term loans being the first one. Again, this is not unlike anything that you've ever done with regards to a car payment, house payment. You make a series of payments of both principal and interest to the lender in exchange for a particular asset or a particular amount of money. Generally, are private placement, maturities between 2 and then I say 7 years, but it could be 8, 10, 12 years, whatever you negotiate with the lending institution. You can see both fixed and variable interest rates, much the same as what you'd find on a mortgage. Some advantages over public offerings of bonds. Obviously, term loans are going to be a lot faster, more flexible. Issuance costs are going to be much lower. Some disadvantages, of course, depending on your organization, you're not going to finance, a brand new building with a term loan. Now you might argue, well, I could, a house of something or something like that. Yes, but we're talking from a corporate standpoint, a multi-million-dollar building probably is not going to be financed through a term loan because you're generally going to be able to get better lending rates and a better deal in the long run by using some sort of bond. And of course, there's maturity limits. You're also not going to finance long term. We're talking 8 years to 15 years, 25-year sort of time horizon through a term loan, or at least not in most cases. On the bond side, of course, much more laborious in terms of getting them off the deck. Bonds have to be issued and registered with the SEC as they are considered a public offering. Of course, government and treasury bonds are issued by the U.S. Treasury. We'll also see municipal bonds issued by local governments, and this is a large segment of the healthcare industry in particular, as they finance and through the not-for-profit side of healthcare. And of course, in the middle there, corporate bonds issued by investor-owned firms, there to finance, again, long-term growth. Most bonds, not all, have 20 to 30-year maturities. We'll see shorter and longer as well. Some organizations, like I know a few years ago, HCA on the healthcare side issued a 100-year bond. But we often will see, and for the purposes of this class, we're going to deal with fixed interest rates. And I'll say up front too, we're going to talk about a par value of $1,000 being the static or standard for this particular course. But from an interest rate perspective, you're going to see floating and variable rates as well. It just really depends on the circumstances and the organization involved. And you can understand when we have floating rate versus fixed rate bonds where the risk factors might lie. Floating rate bonds, of course, are riskier to the issuer. So if I'm organization X, I need capital. I go out to the bond market, issue a bond. If it's a floating rate bond, basically wherever interest rates go and however that interest rate is pegged, I have to pay that because it is a fixed payment structure. Of course, that's riskier to me because I'm not sure where interest rates are going to go, beyond any short-term basis. So, that puts a real concern from a financial standpoint on my mind with regards to being able to pay that on an ongoing basis. Of course, as a buyer of that bond, if I'm the investor, I would rather have a floating rate bond, especially in today's environment where we are thinking that interest rates are going to go up. We might very well benefit as a result. Fixed rate bonds, of course, are riskier to the buyer, but safer to the issuer or the organization, just for the same purposes that I just described, only in reverse. Some other things that you'll hear, and we'll talk about somewhat with regards to bond contracts or debt contracts. One is a call provision. That call provision permits the borrower to redeem or pay back the debt prior to maturity. And you have to realize that a lot of bond investors get into bonds because they do provide a fixed income stream. And so when we talk about buying a 25-year bond at, let's say, 3.5% or 4%, well, that 4% is paid back to that buyer of that bond for 25 years. So it's a predictable income stream that individual or that organization can count on for 25 years. That call premium, basically, or that call provision, allows the issuer of that bond to buy that bond back within some period of time if the interest rates or the market pricing on debt has improved such that they can pay it off and reissue debt, which is what most often occurs. Okay. Because of that risk to the buyer of that bond, the call premium is generally issued or specified. It's an option, so it doesn't have to be exercised. If market rates don't move in a favorable direction to the issuer, they don't have to do that. But it is something that we have to talk about and have to think about when we're looking at a particular bond issue. And hopefully I've satisfied those two questions at the bottom with regards to why we'd want callability. It's just as market rates adjust, and what impact does a call provision have on the riskiness to lenders and to the business. Well, again, it depends on what direction the market rates go, and what I'm relying on those cash flows from an investor standpoint to be able to do. If it's basically keep the lights on in the house, I want to be aware that there is a call option that might be exercised, and I just need to make appropriate financial plans from a personal investment standpoint. Now, as we talked about, and we covered the concept of risk in an earlier part of the course, and how risk actually plays out, and we talked about FICO scores on an individual basis. That same sort of concept applies to organizations, and primarily through what we call the credit rating or bond ratings of the organization. Okay, and there are three primary rating agencies that understand and actually study in great detail every organization within a particular market or a particular segment of the industry. So the three primary houses we see are Moody's, Standard & Poor's, and Fitch. And much like you have a FICO score that ranges from 850 down into, I don't know what the absolute bottom is, but an 850 credit score is equivalent to a AAA rating that we'll see from one of these credit rating houses. Okay, and as we slide from left to right on this chart, those credit ratings basically then imply a higher interest rate charged on any sort of basically debt instrument or any sort of credit that's provided to the organization. Okay, you'll find that organizations spend an inordinate amount of time talking, communicating, soothing fears, really, and this is why we have, or at least one reason why we have a lot of the conference calls from the CEO, the CFO, the COO, as we start talking about from an investor standpoint, and realize that's largely due to what sort of effect it has on borrowing in the credit markets. Okay, but also realize that it's not just the credit markets at least the direct credit markets that look at and evaluate bond ratings. Okay, a lot of times this is going to have a play on your working capital and your trade credit offerings as you start talking about doing business with large vendors, to supply goods or services to your organization. They very much might take an interest in how the bond rating goes. You might find some more savvy employees and other sort of supportive organizations that do business with your firm might look at your bond ratings as a kind of a methodology or a proxy to see how well run the organization is, because that's all part and parcel of what these rating houses are supposed to do when they're assigning these, basically these credit ratings. Now, for anyone that has watched The Big Short, for anyone that hasn't watched The Big Short, the movie, I recommend you watching it, because there is a pretty significant issue with the rating houses as it pertained to the housing market back in the early 2000s up to about 2007, 2008. But when all things are running right and all things are running ethically, these rating houses do a nice job of kind of stratifying the market with respect to the quality of the organizations that are out there and how credit worthy they are. So a lot of the bond rating concepts I've talked about, and don't want to belabor here, but you can see that primarily what you need to understand is there is some objectivity, or a lot of objectivity in terms of measures and metrics, and a lot of subjective factors as well. That's why you will see some variation as you go within looking at one organization. You'll see variation among the houses in terms of how they're rated. Okay. So really the big question, what everybody's interested in with for the purposes of homework, is how do we value one of these bonds? And again, this takes us all the way back to our first basically course, or first section of this course, with regards to the time value of money. Okay, and we have to understand the financial value of any asset stems from those cash flows that we talked about, and where those cash flows occur and how they line up, and basically how long they persist. We have to be able to value them as we learned through time value of money concepts. So with that in mind, a general valuation model that applies to bonds, we can see we have that same sort of timeline. Our present value of cash flows come into some sort of valuation. Okay, and you notice in this particular structure, value really more often, I'd say 99% of the time, we're going to be trying to determine value as of today. What is that bond worth to me today? Is it overpriced, underpriced, whatever the case may be? Is it selling at a discount or at a premium? But we want to know what that is today when we, because generally our decision is going to be made on a very short-term temporal basis. So a couple things that we need to understand, and I'll tell you for the purposes of this class, the par value that we will work with throughout the course is $1,000, which just means basically the face value of that bond. Every single bond has its own denomination, generally in round numbers, of course, to aid in valuation. But you will see variance in the actual market. 1,000, 5,000, and much larger. Okay, but for the purposes of this class, we're going to stick with par value. Even if it's not stated, it's going to be $1,000. We will also have a maturity date. Again, this is a debt instrument, so it has a terminal date. This is not equity, so no matter what kind of bond it is, it will have a maturity date, whether that's 5 years in the future, 10 years, 15, whatever the case may be. Okay, but there will be a maturity date. We will also have a coupon rate. Now, the coupon rate is simply the interest rate on that bond, okay? And we multiply it by the par value to get the actual dollar coupon payment. So if we're talking about a 10% interest rate on a bond, my par value, or basically the payment I'm going to make on that bond, is $100, right? Because remember I said our par value is always going to be $1,000. If an interest rate stated at 10%, 10% of 1,000 is $100, okay? And for the purposes of this class, we're going to sustain a fixed coupon rate, okay? That might change in practical reality. Again, with floating rate bonds, of course, that would have influence on the actual coupon that's paid. Now, why do we call it a coupon? Well, in the old days, and you can still find them rarely or more rarely in recent days, in the old days, that bond actually had basically sections or little areas on the outside of the bond that designated when a coupon could be redeemed for cash. And I actually had a grandma at one point that she had one of those bonds. She would clip it off when the time was right, take it down to the bank. Bank would give her cash, and then of course the bank would turn around and send that particular coupon off to the bond holder and would get redeemed themselves or get reimbursed themselves. Okay, so literally it looked like, at least from my recollection, it looked like the coupons, like little green stamp coupons or perforated coupons that were out around the outside of the bond. But anyway, that's why we call it a coupon. Okay, now another key thing to understand is when a bond is issued, its coupon rate reflects current market conditions. As current market conditions change, bond values change. So as interest rates adjust, okay, as time marches on, that bond has a different value. Okay, and we'll learn how to adjust for that and do so appropriately. Okay, and it's probably not surprising, organizations are concerned with the debt service requirements that they have to pay. This is why floating rate bonds to an organization can be kind of a scary prospect if we expect interest rates to rise dramatically in the out years. Okay, it's the same sort of concern one should have when they're dealing with an adjustable rate mortgage after the adjustment period. Let's say a 5-1 ARM or a 7-1 adjustable rate mortgage. Beyond that initial 5 years or 7 years, there needs to be an understanding of how high some of those rates can adjust and what I'm going to have to come up with in terms of a mortgage payment. Same sort of concern from an organizational standpoint. Okay, and frankly, it's one of the issues we had with the whole mortgage crisis, because people were jumping into these these ARMs at a very low interest rate, but then could not afford it once those short-term rates started to adjust, and they couldn't get financing to get out of that particular note. Okay, so what does this look like from a practical standpoint? What's the value of a 15-year 10% coupon bond if the market rate or my required rate of return on debt is 10%? Well, first and foremost, let's understand what we have going on here on the screen. Of course, we have a regular timeline with our time frames involved, but notice 3 dots here. I go start 1, 2, but I go all the way out to 15 years. And so just for a presentation standpoint, we've kind of condensed this, but recognize that every time hack here, I've got another $100 that occurs. So there's one at 3, one at 4, and so on, all the way out here to 15. Now, with bonds, if I'm selling this bond as an organization, right, I get your $1,000 right off the bat. So this is our par value, right? That $1,000 comes to me at the organization. I take that $1,000 and hopefully I invest it in something lucrative and that's going to help me further grow and develop the business. Okay, and then because I'm using your $1,000, I'm going to pay you 10% every year, all the way out here to 15 years. At the end of that 15 years, I'm going to give you your $1,000 back in addition to that final year's basically interest or coupon payment. Okay, so what's this value? Well, if we take all these cash flow streams at 10% all the way back to zero, or basically where we are today, that bond is worth $1,000, right? So I get this $1,000, you get my coupon payments for 15 years, and you get your $1,000 back at the end of 15 years. What's not to love, right? So here at the bottom we have, well, what would the value of the bond if it were a zero coupon bond? If you don't know what a zero is, basically a zero coupon bond is a bond that does not, as the name implies, does not pay coupon payments, right? So you might actually, so this is a strategy that some might employ. Let's say if I have a child, 18 years from now, I know that hopefully this child's going to grow up and want to go to college. How do I, basically finance that college education? Well, it's a strategy that I've heard some employ, at least within the healthcare community. A couple of doctors and a couple dentists I know basically buy zero coupon bonds with knowledge that they're going to get basically $1,000 at the 18th year whenever that bond actually matures. Okay, so what do I have to pay today in order to get that zero coupon bond at 15 years in the future? Well, if there's no coupon payments, I don't have to pay this $760. That zero coupon bond I can actually buy today for $239.39, and again, 15 years in the future, I get that $1,000. Okay, so hopefully that helps illustrate how the bond valuation process works. but now we're going to start to tweak it a little bit. So before we go there, actually we can do this valuation, of course, in Excel. We're using our good old friend, the present value strategy that we've seen before. Here our rate is 10%, and again, you can put this in as 0.1 or the regular 10%. We have 15 periods in play. We have a payment. We're using the payment function here of $100, and our future value is $1,000. Okay, and I again ignore the type, close my parentheses, and my cell display is $1,000. So based on all these factors, this bond's worth $1,000. That's what I pay you. Okay, you get my bond, and basically we march forward from there. Okay, so what is the value after 1 year if the interest rates remain constant? Well, if interest rates remain constant, that means rate stays the same. Stays the same at 10%. We have 14 periods now instead of 15. Payments 100. Future value is 1,000. Everything stays the same. It's still worth $1,000 because market conditions, other than time, have not changed. Now, suppose interest rates fall so that the required rate of return on debt is now only 5%. Meaning that this is the market rate right now for, and you can call this maybe the average market rate, is 5%. Well, what happens is I, of course, adjust my rate. My number of periods still stays the same, okay, at 14 years. Payment stays the same, future value stays the same, but my rate essentially has been cut in half. This bond is now said to be trading at a premium, okay? And if you think about it logically, okay, again, this is a fixed rate instrument, okay? I got your $1,000 as the organization. You're holding this bond that is paying 10%, a 10% coupon for the next 14 years, right? That means, and that coupon, of course, is reflected in this payment, right? But for the next 14 years, it's well over, in fact, it's double prevailing market rate. So if I wanted to buy that bond as a third party, and I said, hey, or you need cash, and you want to sell this bond, that bond is now worth $1,494.93. Okay, it's said to be selling at a premium because it is basically paying double what the prevailing market rate is. Okay, now conversely, if we're looking at the market rate is now 15%, you're holding this 10% bond. That means that if you want to turn around and sell this bond, right, that you bought from me a year ago, you would have to basically take a haircut, and you would only be able to sell that bond for $713.78. Okay, and again, logically, this should make sense because you're holding a bond that's only paying 10%, whereas everybody else out there that's that's working and basically buying bonds or buying organizational bonds are going to get a 15% return, so they can get a better rate than what you have to offer in the bond that you're holding. Okay, so that bond is said to be selling at a discount. Okay, and again, this is where and how as interest rates rise and fall, how bond valuations change. Okay, so if you think about where we're sitting right now with regards to long-term debt, the bond market, and what's happening with the Federal Reserve and how Janet Yellen and the Board of Governors of the Fed are talking about raising rates, specifically starting with the federal funds rate and beyond. This should hopefully inform your line of thought with regards to where bond valuations are going to go at least in the near future with existing bond issues and what they're going to be worth. So with that in mind, as we grow closer and closer and closer to maturity, okay, we will eventually, you'll see that, and if you play the math out, you'll eventually see that bond valuation will eventually, whether it's a premium bond or a discount bond, both will eventually basically terminate at that par value. Okay, and and it's just something you have to understand, and if you want to study it further. But eventually you'll always get back to that par value. It's just a matter of where you're transacting with that bond in time during the life of that bond to determine what sort of basically valuation you have. Okay. Now, the return you get on a bond consists of that interest payment, that basically that coupon, and any sort of price change, assuming that you were going to sell the bond at that particular point in time. Okay, so we talk about the current yield and the capital gains yield. Current yield is just that annual interest payment over the current price of the bond, and then capital gains is the change in price basically divided by the beginning price. The two of those components together are your total return on that bond. Now, another term you need to understand is what's called yield to maturity. Is that basically is the expected rate of return on the bond, assuming the bond is held to maturity and no default occurs or is expected. And essentially, it's not unlike basically the internal rate of return valuation that we've talked about previously in the course. Okay, it's the discount rate that forces the present value of the cash flows from the bond to equal the bond's price instead of zero. Okay, so in this case, instead of us wanting to get down to zero for an internal rate of return calculation, we're trying to get to the current price that we see in the market. So with this in mind, we take all of our discounting and we basically do a yield to maturity calculation. Of course, we can do that on an iterative standpoint, play around with the numbers, but we can use Excel as our good friend. Basically type in the equal rate function. We type in the number of periods, which of course at this point is 14, the payment involved, the current price or the present value, and the future value is 1,000. Of course, we skip over type, close the parentheses, and we end up with 5%. Okay. Likewise, if we're at the current position of $713.78, coupon rate's $100, 14 years, so on and so forth, that means that we actually are getting a yield to maturity of 15%. So depending on where you're buying a bond, depending on what the market circumstances look like, it may or may not be to your advantage to buy a bond in the market, and depending on what it's selling for. So now, also important to understand that bonds typically have semi-annual coupons. So just the same as what we started talking about with regards to semi-annual and basically breaking up the valuation process into segments within a given year, we're going to have the same sort of process or mindset when we start looking at bond valuation. Now, with this in mind, there are twice as many interest payments compared to the annual coupon. We have to cut that interest payment, of course, in half, and our required rate of return is only half of the annual rate. Otherwise, everything else is the same. So if I look at the value or the valuation process for a semi-annual 14-year 10% coupon bond, required rate of return is 5%. I take my rate, right, 5%, I cut it in half. I double the number of periods right here to 14. My payment, of course, is 10%. That's usually 100, but because it's semi-annual, I cut that in half to 50. But my future value remains the same at 1,000. And of course, close the parentheses, hit enter. I get $14.99.12. Now, I also want to be able to do this from a rate standpoint, a yield to maturity. So if I'm doing the same sort of calculation on a semi-annual bond that is selling in this case for $1,400, 14 years, 10%, I again open my rate function, double the number of periods to 28. The payment is reduced to 50 as it was in the prior slide. Present value in this case is $1,400. Put that in with a negative. Future value is still 1,000. Close the parentheses, and I get a cell display of 2.895%. Now, be careful. Many of you will make the mistake of getting this result and entering this in as a solution, and will get frustrated because you get it wrong. Okay? What did you actually find here when you got the 2.895%? Well, you did not find the yield to maturity. You found the periodic rate for half of a year, because this is a semi-annual bond. So don't jump immediately to conclusions, right? this 2.895 actually needs to be doubled, okay, to get our full yield to maturity of 5.79%. That's our full answer. Now, of course, if I gave you a problem that was looking at a quarterly bond, okay, that means that we would have to divide everything, or multiply by 4 in this case to get the number of periods. We'd have to divide the payment in fourths. Okay, present value, future value would stay the same. We would get a quarterly rate, which of course then we'd have to multiply by 4 in order to get the full yield to maturity. So don't get in a hurry. Take your time, think about what you get, and you should be okay. Okay, so that's the bond side. Now on the equity side, as easy as bonds are to evaluate from a valuation standpoint, equity is not at all easy. And I will say that I'm going to talk very superficially over a lot of the equity valuation tools and techniques, simply from the perspective that so much of what we see in the equity markets is based less on actual characteristics of the equity investment and much more on expectations and kind of the wild spirits, as some would term, of the equity markets. And this is why we see the wild whipsaw effects on valuation pricing that we see on various equities on a daily basis as we examine the stock market. Okay, now certainly some of that is grounded in practical, the valuation of a company, let's say, based on expected earnings, and existing asset structure. But a lot of it is truly based on fluff and simple, expectations, or lack of any better term, simple, again, wild thoughts and aspirations for what somebody hopes is going to occur with a particular investment. Now, it's also important to understand the size of the equity market in comparison to the bond market, and with only one notable exception in 1 year, the size of the bond market dwarfs the stock market. And realize the stock market, we're talking trillions of dollars in assets, right? The bond market is well above that. Okay, because from a purely tactical standpoint, bond markets tend to, of course, you're not giving up as much control. Bond markets tend to be the primary source and the cheaper source of capital versus equity. And often in an organization, as they continue to tap or continue to go out to the equity market, it's considered to be a negative signal to the market, and thus, people start to question, whether there's some liquidity issues, whether there's some organizational or control issues. Once we get beyond the initial public offering, going back to the equity markets is often not a good idea, unless there's some other type of tactical or strategic advantage that can be incurred. So with this in mind, typically we talk about equity from the for-profit side. Of course, we also can talk about equity on the not-for-profit side. It's just often will be lumped into sometimes called fund capital, or often fund capital when you start talking about not-for-profit accounting. The organizations on the not-for-profit, in the not-for-profit space, still have equity. It's just that how that equity is actually distributed, which it isn't on a not-for-profit side. It's far different than what we see in the for-profit enterprise. But there's a good link here from Investopedia if you want to click through. Might be a good source from some additional information. So sources of equity capital, we've kind of talked about some of this already, from personal savings to public stock. Number of different sources where folks might actually basically throw capital at you or contribute or pour in capital to your organization. Now, from a superficial standpoint, you'll can see in the textbook, there's a lot of different valuation techniques, many of which are based on dividend payment and some expectation of future growth over time of that dividend. It might be growth of free cash flows over time, the valuation of that stock, and just for clarity purposes, valuation at time period 0, so that's today's stock price, is a summation from 1 to infinity of the dividend growth, basically divided by 1 plus R over T. So basically this is our interest rate over time. Or it's the free cash flows that come to equity, basically any residual cash flows after all debt service is recovered, divided by, again, that same sort of denominator. Problem with it, and we'll talk about this, is one, not all organizations pay a dividend. Free cash flows, we'll talk about sometimes and oftentimes can be difficult to predict, especially as we're going out to infinity. So a lot of uncertainty from my perspective of what we might find within that particular valuation process. There's also in the book, you can talk about the Gordon growth model, where they basically are making the assumption again that dividends are the correct metric to use for valuation purposes. I can give you a litany of companies again that don't pay a dividend, Berkshire Hathaway being one of them, Microsoft, I'm not sure if Amazon does, but a lot of organizations for a number of years don't pay a dividend. Of course, they see an impact on their valuation when they decide to do so, because it does attract more investors, but very much from a personal standpoint, very much a skeptic of this valuation model as well. We will also see valuation based on price multiples, or basically the price to earnings ratio, price to book, price to sales, price to cash flow ratio, again, all of which you can unpack in your book. The problem that I have with some of these multiple valuation sort of strategies is, of course, everything is based on historical context. In a lot of industries, and I come from the healthcare side of the fence, our industry in particular is going through a series of system shocks that I'm not sure that we'll recover from for a good long time. Right or wrong, depending on what spectrum of the political aisle you come from, that certainly has an effect on basically the impact on earnings and what we might actually see in stock price. So again, even though it's all historical, I can look back over the last year, 2 years, 3 years, whatever. At least in some industries, particularly the one that I'm most affiliated with, our ability to basically project forward of some sort of valuation for a stock based on historical context is very, very limited. Now, that varies by industry. I'll be the first one to admit that. Some industries that are kind of solid and static and really are kind of march forward on the not as much volatility, these sort of multiple based pricing models might actually do some good. But for those that are more volatile, I have some hesitation. There's also asset-based valuation, where we have the book value of assets and liabilities. We estimate it. We come up with a market value of assets and liabilities, and basically look at the market value of all assets minus any liabilities, and we come with a market value of equity on that particular instrument. Not too bad. Actually, I like that a little bit better, but again, that does not give us any sort of forward projectionary sort of perspective. So there's advantages and disadvantages on both sides of these. I'm not going to be asking you in this particular class to go through valuation methodologies that I don't personally use and don't really lend a lot of credit to, but I want to put them in front of you just so you know about them. And of course, in our resource discussions, you certainly are welcome to dig down into them and say, hey, I really am interested in the Gordon growth model. I want to know more about it. Okay, knock yourself out. There's nothing wrong with investigating further, but realize that we have some advantages and disadvantages to each one that are listed here on your screen. And again, in different contexts and in different organizations, some may be more valuable than others. And really, we're talking about a pretty squishy asset valuation process. But I also want to put this out in front of you. And in full disclosure, I am an investor and have some personal stock in Berkshire Hathaway. I've attended the annual meeting there the last couple years. My dad actually lives in Omaha, so we kind of make a family weekend out of it, which, I mean, I don't know how much more geeky you can get. A couple old guys, sitting listening to a couple of much older guys. Warren is 85 and Charlie Munger, I think, is 93 at this point. But both sitting there, billionaires. You have the CenturyLink Center in Omaha that by 7 in the morning is filled to the rafters from people across the globe coming to listen to these two gentlemen talk about not only the Berkshire Hathaway organization, but we talk everything from healthcare to macroeconomic policy, microeconomic policy, where the world is going across multiple dimensions. Very educational if you're into the business side of things. But probably one of the most educational things that actually is listed in the 2016 annual report on pages 21 to 25 talks about basically this issue of basically stock valuation, particularly active stock valuation and active management versus basically passive investing. And you can see the quote here by Warren. I encourage you to click through that link, read these pages, and there's of course a lot about Berkshire Hathaway because that's the nature of the annual report. But Warren is probably one of the more successful investors. They call him the Oracle of Omaha and all that. But some of his practical investment advice is well worth the read and well worth your time. So with that in mind, what this really brings us to is this concept of the efficient market hypothesis. Now, I bring this in and I agree, or I suggest it's not a direct overlay with what we talk about from an individual equity investment sort of perspective. Okay, but what we're really after in this whole process of equity valuation is understanding exactly what the equity side of our capital structure is really worth and what it costs us. Okay, so part of that, of course, is this, and part of this valuation process is really trying to understand that the equity side in a little bit more tangible terms than what we might find through some of the other valuation processes, whichever one or ones that you choose to pursue. Okay, so one of the things that quite honestly, and it kind of ties in with what Warren Buffett had to say on the prior slide, is there is a certain amount of understanding that yes, you can beat the market in a short period of time. There are some arbitrage opportunities that do present themselves every once in a while, but because there are so many individuals and organizations and institutional investors all taking part in the market at the same time, those opportunities are squeezed out very, very, very quickly. Okay, so really what the efficient market hypothesis talks about is securities are fairly priced based on their future expected cash flows, given all available public information that's available to investors. Okay, as such, because there are so many actors, it's probably considered it is considered the nearest thing we have to a perfect market. Okay, and you shouldn't be able to earn abnormal or excess returns over a long period of time. In fact, if you go and you read in the Berkshire Hathaway report, it's one of the reasons why I want you to read it, Warren actually made a bet, and this is actually on page 22 of the annual report, where he actually put up $500,000 of his own money, and with basically the bet, there's a strategy in there, and he talks about a number of different other individuals that kind of went through this, what they call the long bet process. Basically, where individuals were willing to make a bet that something is going to happen, or something can be proven or disproven, whatever, and then all the monies go to charity. It's kind of the way that rich people get their kicks, I guess. So, with that in mind, he made the bet that nobody, no active investor, no active management firm could beat the S&P 500 index over an extended period of time. So he put up $500,000 of his own money, and as he said in the report, he waited to see if anyone would take the bet, and what he heard next was the sound of silence. Eventually somebody did. They ponied up their own $500,000 saying, I can beat that. I can beat the market over an extended period of time. And I'll let you dig into the annual report on page 22 to figure out for yourself whether that's true. Okay? And to make a short story long, basically the efficient market hypothesis, the index investing side of things soundly trumped the active investment side. Okay? So with this in mind, we have to then come back to this understanding. The only way to obtain a higher return is to assume more risk in the equity side of things. Okay, and this is truthful too when we start looking at the debt side of things. When we look at the bond market, the only way that you earn a higher return from an investor standpoint is if you go down the scale a little bit when you're looking at investing in a bond. Those AAA rated bonds are going to pay a fairly low interest rate because they deserve to pay a lower rate in the credit markets, right? If you want a higher return, you're going to have to absorb or onboard a little more risk to earn that return. Okay, so again, encourage you. There's another video here that pertains to the efficient market hypothesis out there on Investopedia. Encourage you to check that out. But this brings us full circle then back to when we start looking at equity investments, brings us back to our old friend, the capital asset pricing model that I introduced in the risk and return section. Okay. And again, nothing has changed with this model. We still have the beta coefficient. We still have the expected return on the market minus the risk-free rate. But with this, what we're able to do then, and with a couple of assumptions that I've already introduced in the other section, we can actually, and forgive me here, I'm going to open up my my browser window. And I can actually show you how this is put into practice within numerous industries. And this is actually, I take it from the Stern School over at NYU. This is something, again, you can click into and can actually develop an awareness of where your particular industry plays out in terms of the number of firms, the average beta coefficient, the basically division between equity and debt financing, and ultimately the cost of capital that we're really talking about for that particular industry. Okay, so encourage you to take a look at your leisure. I think it's kind of going to set up what we're going to be talking about next with regards to capital structure and the cost of capital. And with that, I'll end this video. Thanks so much for your attention, and we'll pick it up in just a few minutes.